Welcome back to my channels, and if you have not, please do like and subscribe. It just helps me reach more people. And also, if you have any question, don't forget to comment. I answer all questions, so yeah, just comment below and I will answer as soon as possible. So today topic of today's video is what strike price to choose. A lot of people are confused about like what strike price to choose, and maybe you see some examples where somebody has like wider strike price and it's just expensive, so how can you convert that to the smaller one and things like that, right? So when you are buying naked options like I mean, not a spread, just the option, just one option color put like what strike to choose. Also, what strike to choose when we are doing leaps. So let's get it started with let's take a let's talk look at the spreads and options on Tesla. So I'm gonna go, this is Robinhood platform. You can use pretty much everything. So I have pretty much everything, but it seems like a lot of people using Robinhood. That's why I chose to use Robinhood. I'm trying to get away from Robinhood, so I mean, yeah, it's your own preference, but let's look at this, right? So let's say, so Tesla is 1835, right? So let's say you are playing, a lot depends upon what you want. Let's say right now, if you see, some people are maybe choosing like, I don't know, like some ridiculous amount, for example 25 for this week. I mean, it may happen, but it's 234, right? And if you look at, that's quite a volume, that's a quite a volumes on this. Looks like, wow, 10,000, that's pretty. But the thing is like theta, right? So this is 234, but theta is negative 193. That means basically if the price is flat tomorrow, your option will be like it's not exactly accurate, but about right, it will lose 1.93. So basically it will be like 40 or $50 tomorrow. Today it's 234. Basically it has, even Tesla opens flat, right? Because it's way too far away, so theta gonna eat. That's why when you are doing, so you probably like, if you can afford, you don't want to do that far away. Again, if you think like 2-3 months away, that's fine, it can go. And the thing is like, a lot of people are still confused like Tesla will never reach, the price has to, does not have to reach that strike price. You can always close that out. For example, let's say Tesla is 1500, right? Your strike is 2000. So if Tesla goes from 15 to 1700, the probability of getting from 70 to 2000 near, right? So the option value appreciates in value, so you will make some money. It doesn't have to reach the target. But again, the theta, if you are out of the money, theta will be huge and you will lose money a lot. So one thing is definitely don't go way far out, right? So what options you have, right? So uh, basically it's 1835. If you want to do, it's expensive, but if you probably want to do is, let's say if you don't have a lot of money, so you probably want to do like maybe 1900, something like that, right? So 1900 is still probably 4000, so it's quite expensive. I mean, if you don't have much money, you probably should not do just the naked. You can do spreads, but I'm gonna go over that too. But I think you got the idea, right? But the one thing, the best thing you do, usually Tesla is really expensive stock, so I don't know, like this is probably not, let's look at something like a little cheaper. Let's look at the Square, and not necessarily cheap but pretty good. And if you go to Square option, Square has a huge nice run up, right? So it's 52, so if you do 55, 250, right? But the thing is like 55, you paying 250, so $250, but it's 52, 53. So you paying everything, whatever you paying is extrinsic value. I have a video on extrinsic and intrinsic value, do check it out if you don't know what does it mean. But if you look at that, it's not 55 yet, it's but you paying 250. So if you look at this, your theta, it's gonna decrease by 43 if it, even if it opens flat. Like that's why what I suggest is when you are buying, let's say even intraday it works too. Even you are doing intraday or weekly, always try to buy in the money. For example, it's 52. Think about like if you buy option for um, 145, you're paying $8. But if you look at that, you are already $7.38 in the money. So basically you can literally exercise this option and get $7.38. So 738, so $738. So $738 you are in the money. So you, all you paying is like $1.43. Also, if you know that, I mean, if you look at the theta, it's 30. You're losing $30 only. Like if you buy this option, you're losing $30 if it's open flat. Whereas if you buy way out of the money, right, your theta is 43. See, like theta increases, and if you do more up, let's say 160, um, your theta is 35. So it just basically kind of increases as you go up. So uh, that's, of course, it's going to be cheaper, but you might get, like, if it reaches there or strike through it, you may get a larger percentage gain, but it's not the safest way. So always, if you are doing naked, always try to do in the money. You doesn't have to go deep down, but even if you do 150. And the other thing is, like, if you are in the money, your delta gonna be high. What does high delta means is, for each dollar move you will get more money than you are, like, for example, 62 per dollar move. Let's say 160, it's 22. So basically if it's 160, for each dollar move you'll get $22. Whereas if you buy 150 call, you get more. So that's why deep in the money kind of helps. And the other thing is, like, a lot of people are doing spreads, and like, which spread you do. What I do usually, it's just my strategy, everybody has their strategy. What I do is, I always do buy in the money call like 150, then sell something like 160, let's say, right? So that's gonna cost me buy call this, and sell call this. So it's gonna cost me 360. So I'm risking 360 to make 1000 minus 360, so almost 640. So 640, that's my max gain. And if you look at this is a pretty good deal. I'm already in the money 238. So basically, literally, if this happens, opens flat, I'm not losing much. I mean, if its price remains the same, I'm making $2.38. So so basically $1.20, I'm losing $120 only. Maybe you guys are confused by $1.20, like you multiply by 100 options. So basically that's how it works. So spread I always do in the money. So why I do is, if you buy in the money, is usually you don't pay much for extrinsic time value. You pay the intrinsic value. So you're buying kind of cheaper, in the sense you're not paying the extrinsic value, and you selling. Selling is you get the extrinsic value, and selling is basically you collecting that, right, which is reduced. So that's why, that's my strategy. And the other thing is, like, let's say somebody mentions in the chat or somewhere, you saw like somebody buying 150 to 200. So what do you want to do? You could do just 150 to 155 or 150 to 60. So basically your max gain gonna be the width. So 150, 155 minus 150, so $5 times 100. Of course you have to deduct your premium, so that's going to be your max gain. So you could adjust accordingly. So that's how I choose. And a lot of people are still confused about, like I'm saying, today I was kind of talking about BAC, Bank of America, and I got like some leap at 10 strike. So people are like, why I'm getting 10 strike leap? And the thing is, like, if you look at that, right, so if you look at I got 22. That's, so if you look, let's say if you are getting like 30, right, you are not even in the money. So it has to reach, like, it has to go $5 up to make that money. Basically, if it reaches like 29 by that year, you make zero. You don't make any money, because you lost 264, basically not much. So you lost a little bit, but basically you did not make any money. That's why all I do is, like, I go deep in the money. So if I do like 10, right, so for each dollar move it's 98, like literally a dollar. So it's like owning a share. So, and a lot of people are kind of confused, like, what if price goes down? It's same thing again, right? If you had 100 shares, and if price goes down, actually it's even better. Like, if you have 100 shares, and let's say price drops from 25 to 20, you're losing like 5 times 100, $500 in your option too. You're losing probably like 98 times 5. Probably delta gonna get lower as it goes down. So you are not even losing 500 in your options, but you are losing. So I think Leap is a great way. I mean, all you need to do is, and the other thing is, like, really cheap. Like, you're paying 26. So for time value 16. If you can get this, like looks like it's a mark, and low was 15. So if you get it like $16, so think about it, like, so 10 plus 16 is 26, so you paying like $12 only for this option as a premium for time. So that's really cheap. Literally you could do is like, you can watch my video on how to do sell covered calls on the leap, so you can literally make like $12 in a week. So it's basically you are buying 100 shares at deep discount. So I like that, and that's why I go deep in the money. And if you see, if you go 20, right, if you go 20, it does cost 750. But if you look at this, right, 20 to 27, 25, 26, 27, so you pay a little bit of premium for the time value. So as you go up, you pay premium. That's why I always do deep in the money. A lot of people say kind of your capital is kind of you are holding more capital. Again, that's true too, like depend upon a lot of your strategies if you are really active. Because for this leap I'm looking for long term, and that's why I like my safety, and also I like my delta. So that's why I really like deep in the money, and especially like Bank of America cheap. So that's yeah, that's it for today. And if you have any question, comments, or any suggestions, do write in the comments below. And yeah, I'll see you. Thank you.